Good morning, everyone. This is Marshall Giller bringing you the morning comment for August 25th. Fed Chair Janet Yellen Friday showed what an experienced central banker she is, as she made a speech that sounded profound without actually saying very much, just that she's having trouble interpreting the labor data because of structural change. The line that captured the market's attention was when she confirmed the message from the July FOMC minutes, that the debate in the FOMC is no longer about whether to raise rates, but rather when to raise rates. Or, as she put it, the question of under what conditions we should begin dialing back our extraordinary accommodation. So, the die is cast in the U.S. for further tightening. While everyone's attention was focused on Yellen's speech, in fact it was ECB President Draghi who surprised the market with new revelations. He showed that he was becoming more concerned about high employment and low inflation by 1. Backing calls for countries to be allowed to spend more, and 2. Admitting that inflation expectations were no longer firmly anchored, as he says every month after the ECB meeting, and revealing that, quote, the Governing Council will acknowledge these developments, unquote, and take further action to deal with them. The two central bankers thereby drew a sharp distinction between the future course of monetary policy in their respective areas. As Draghi had frequently said, this divergence in policy is likely to drive the euro down further against the dollar, and indeed against many other currencies as well, in my view. The euro fell against the yen and sterling this morning. Meanwhile, the dollar gained against every free-floating currency that we track. Fed funds rates expectations for 2017 gained 4 basis points on Friday, but they still have a long, long way to go before they match the FOMC's forecast. So I think the market has much further to go before the Fed's likely moves are fully discounted and the dollar can strengthen further. Today is a holiday in the UK, so with the London market closed, FX trading may be thinner than usual. The main event during the European time will be the German IFO survey for August. All 3 indices are expected to have declined, which could add further pressure on the euro and give investors a reason to push euro-dollar back below the 132 line. In the U.S., new home sales are estimated to have risen, adding to the recent robust data coming out for the housing sector, and probably boosting the dollar, in my view. The rest of the data isn't so encouraging. Preliminary market service sector PMI for August, and the Chicago Fed National Activity Index and Dallas Fed Manufacturing Index for July are all forecast to have declined modestly. Usually, however, these indices aren't market affecting. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Marshall Giller, Head of Global FX Strategy at IronFX Global, wishing you solid trading.